How's it going, everyone? This video is going to be over the inducement model and how it is similar and different to the 2022 mentorship model. So starting off, you have some sort of high put in, liquidity resting above, you run that liquidity, break structure, and you have some sort of internal ranged liquidity right here that is then ran before a move down, fitting in with the 2022 mentorship model, and you have some sort of entry into the fair value gap that induces people to go short. It then starts to go short, people move their stops to break even, it runs those stops before the real move happens. So here's an example of an inducement model. We put in a low, lower high, we run this low, sweeping the liquidity, grabbing it, put in a high, breaking structure, put in a low that induces people to go long, right? We then run this low before the actual move occurs. Looking at this right here, right? Where would our break a structure be? Right here. Our inducement, right here. And our liquidity grab is right here. And like I said, I do like to see some sort of fair value gap in there. So if you look right in here is where the fair value gap was, this 5-minute fair value gap that got touched. So that's what I like to see. So here is a higher time frame example. And if you can see right here, we have a fair value gap right here, or on the hourly, it would be right here, right? And so when we reach into here, people go long, put their stops below, and you can see, once again, people go long here and put their stops there. So what is resting there? Liquidity, or that would be our inducement. You have your inducement, you break this structure up here with displacement, an aggressive move up, then you run, you deviate from this range here, right? So this is where you want to be looking to go long. Here is a 1-minute example. And so you can see we reach into this fair value gap right here, actually run whoever got short right in there. And then we get a move down, making equal lows. So you expect these to be taken, right? Have relative equal lows there. And right there, we get an entry into this fair value gap, right, to go short. So that is what induces people to go short. So they have their stops now resting there. Now before the real move, what happens? Well, we have equal lows here, right? Never went for these lows down here yet. And what happens is we run these stops right here into the fair value gap before the real move occurs. I hope this gives you an intro into the inducement model. I would go experiment for yourself, but really it's just internal liquidity in a range that is ran before the actual move. Thanks for watching.